Ladies and gentlemen, welcome to the third conference on asset management for occupational pensions. Before starting, let me first thank our distinguished speakers. As you will notice, we have a fantastic lineup of well-known professionals and academics who have impacted financial markets. Let me thank also our supporters and sponsors. In particular, let me thank our gold sponsors, Alpha Asset Management and PCS, our silver sponsors, Alpha Trust, Piraeus Asset Management, Prodea Investments, and Systemic, our media partners, Athena, Euro Today, Finance Pro, NextDeal, and also I would like to thank the CFA Society Greece and C'est La Vie for their kind support. Of course, I would also like to thank our chairs and moderators. I would like to thank the co-organizer of this conference, Mr. Theodore Economou, who is going to moderate the final panel today. And of course, I would like to thank you for attending today from all over the world. Last but not least, I would like to warmly thank Mrs. Fotini Trapalis for her wonderful support in the administration of this conference. As I said, this is the third time that we are running this conference. The conference is organized by the Institute of Finance and Financial Regulation, which is an international research center founded under the auspices of the Department of Banking and Financial Management of the University of Piraeus. It comprises a big team of renowned academics and professionals, and its motto is Access, Connect, Share. So the aim and the mission, if you like, of the Institute is to bridge the gap between cutting-edge research and the industry. As you will notice, today's conference covers a range of topics ranging from best practices for asset management for occupational pensions to policy questions and regulation. It is also going to address ESG and real estate issues. Without further delay, I would like to give the floor now to Mr. Bill Kelly. Bill is the president and CEO of the Chartered Alternative Investments Analyst Association. Bill has a very rich experience before joining Kaya. He has served in a number of C-class executive positions, and very impressively, he has been one of the co-founders of Boston Partners Asset Management, which was subsequently being sold to Robeco in Amsterdam in early 2000, if I'm not wrong, Bill. So, Bill, we're delighted and honored to have you with us to open this conference. The floor is yours.
George, thank you, and thanks to Theodore as well for the kind invitation. And I'd be remiss, George, if I didn't start by thanking you and celebrating the 5th anniversary of IFFR, an organization I just learned a little bit about in the last several days. But anybody that's focused on excellence and connecting the industry with academic research has a soft spot in my heart. This is exactly what Kaya has been doing for 20 years. We just celebrated our 20th anniversary in 2022. And we're looking to professionalize and standardize the field of asset management. So there, we're very much kindred spirits. So thank you for all that you do. And as you think about this conference today and why does this matter, and if you look at it through the lens of an occupational pension plan, or maybe in US parlance, a defined benefit plan, it matters a lot. And if I think about, again, this is going to be a decidedly US lens to some degree, but I think it also works very well globally. The retirement promise of my parents' generation is largely broken and has moved into the category of a wing and a prayer. And I use my dad as an example. I'm down in New York City today. I stopped to see him on my trip down yesterday. He's 92 years old. He worked with the same company his entire career, retired when he's younger than I am. And the only exercise he now gets is every 2 weeks, he gets in his walker, goes across the street and pulls a check out of the mailbox. He doesn't worry about longevity risk. He doesn't worry about global economic crises. He doesn't have to worry about wars in various parts of the world. He doesn't have to worry about investment risk. This has been taken care of for him. The shift now has very much moved from a defined benefit construct to defined contribution, but defined benefit is still there. It's still there for the public worker sector to a very large degree. But I want to point out maybe three issues that I think could be highlighted throughout the course of the day today, either directly or indirectly, and bear mentioning. The first is some of the risks in the DB system. And George, I'm going to steal a line I think I saw from one of your decks recently, just looking at them over the weekend. VAR, value at risk. It's a measurement about the left tail risk and what the risk is in an individual investment and overall portfolio. But if I have it right, it also refers to maybe the biggest risk, which is the funding level of the underlying pension plan. They've made contractual promises to the individuals. In many cases, these plans are not fully funded, and it's a function of the return assumption in many cases. And we've had an awesome market since the global financial crisis. The central banks have had a lot of intervention. The risk on trade has been alive and well, and has been pretty much one upward cycle for the better part of a dozen years. And this has topped up many, many pension plans through the end of 2021. But 2022 is a very different story. We're seeing some of these fiscal year returns coming out for fiscal year ended June 30th, and they're very much red numbers and maybe deep in the red. And I think we're going to be in this cycle for some period of time. So the funding level of these plans, I think that's the risk we need to be paying attention to, and at what rate are those liabilities being discounted back again. In the public pension plan space in the US, it's still 6.5% to in some cases 8%, and it's going to be very, very hard to get there no matter what your asset allocation mix is. And then around the world, and very much true in Europe, the demographics and the dependence ratio is moving in the wrong direction. We're getting older. We have more retirees for workers. That puts a strain on the funding levels, puts a strain on the cash these plans need to carry. Secondly, the trends in the DB system, they are in secular decline. The retirement promise, I use my dad as an example. My generation, it's now on me. I have to manage around all of these risks, longevity risk, investment risk, et cetera. And how have we done? In the US, the answer is not so great. And I saw a stat from PwC. They looked at various age breakpoints, and they looked at the average or the median savings of people in the range of 55 to 64. They have $120,000 set aside for retirement. If you do the quick math on that, in many cases, it has to be taxed because this has been saved in a tax-deferred way. But assume there's no tax coming out the other side, and assuming that these individuals live for 30 years, and at 55 to 85, that's a realistic assumption. Over those next 30 years, that allows them to spend $333 a month. And if you think about the price of just petrol or gasoline, that's not going to go very far. So I think we've put a very complex structure in the laps of the individuals and have not equipped them well enough to do it. The last point I want to talk about is alternatives. It's the raison d'etre for Kaya. I think broader diversification is a big, big plus. But if you look at Preqin and some of the research out there, Preqin is expecting a doubling of alts in the next 5 years, which on the one hand, if you're in the education business, if you're IFFR in Center of Excellence and thinking about emerging academic research with the industry, these are all maybe very good headlines, but the news story is a little bit more troubling. More alts, why? And if people are thinking that these alts are going to get them to that 8% or 12%, and this is the gravy train they're going to ride, they're going to be sorely disappointed at the end of the race. The median returns in the private markets, and if you look at private equity as an example, the median returns look exactly like the public market proxy. The dispersion of results in that median to the top quartile is separated by thousands of basis points. So to think that the average investor is not going to get the average return is absurd. So we've got to be asking ourselves, why is the public pension plan? Why is the occupation plan? Why is the individual running toward alts, and what are their expectations? I think about this next turn in the cycle, and I think about greater diversification, less volatility, less drawdown risk. They don't sound like outsized returns, and this might be a period of time where you've got to maybe dampen down your volatility and have better risk-adjusted returns. And you got to take what the market has dealt you. And I think we have maybe expectations that are a bit out of whack. Maybe to wrap this up, and I can't help myself, but maybe finish with a reference to Greece. And this isn't just in deference to George and his colleagues. Laura Malini's in the audience, and she can attest to this. This is a page I use in a deck, particularly when I talk to students around the world, which I love doing, and I often do in the course of my travels. I finish with the bust of a head of Hippocrates. And I start by asking if anybody knows who this gentleman is. Some cases they know it, some cases they don't. Certainly if I was in Greece, they would know right away. The father of modern day medicine. Medicine is a profession. It has its flaws, but it is a profession. And if you think about the Hippocratic oath that Hippocrates brought to medicine, one of the oaths that those professionals take is they will not suffer from therapeutic nihilism. They will not overtreat the patient. We have to bring therapeutic nihilism into our industry. The GP needs to sit down with the LP and have a discussion about the liability side of that balance sheet. What are their expectations? And if they're bellying up to the bar of the private markets, thinking that that's going to bridge the gap to higher returns over the long term, they could find themselves sorely deluded by that. And that conversation must happen. It's a bit about the lion lying down with the lamb, and that's a critical part of this value proposition. Yet if I think about the likelihood that a big GP in the private equity space is going to say to the big public pension plan, you know what, I'm not going to allow your allocation into my fund because we're simply not going to be able to meet your needs. That might happen in fantasy land. I don't think it happens in our industry because we are not a profession. I don't know if we can professionalize what we do, but we need to mint more and more professionals. We need forums like this where there's greater discovery, greater conversation about the risks and opportunities that are in front of us in a very realistic way. I saw the outline of the panel today. My friend Mario was on later on in the program. It is a world-class program, George. It's an honor to make the opening remarks, and I encourage all of you in the audience, interact, engage, and seek better outcomes for your end investors. So with that, George, I'll turn it back to you.